Hello everyone, this is Ted Bauman here, editor of the Bauman Letter with your Bauman Friday video. A couple of things before we start. I'd like you to click on the link above my left shoulder. There'll also be a link down in the bottom of the description to see a new offer that we've put together for my service, and it's really focused on renewable energy. It's about a $16 trillion industry that is really going to hinge around one critical thing, and that's what this report is about. It gives you an entree into what I think is the single most important part of the renewable energy revolution. It's one that almost nobody's talking about. And I've identified a couple of companies that we can actually play to get in this part. And the best thing you can ever do in investment is to find the stuff that nobody else is looking for. I won't say nobody, but I haven't seen very many people identify this particular part of the renewable energy revolution. So click on the link there or in the description to see what's going on. Second thing is, a couple of people asked me about the shirt I was wearing last week. No, it's not a Middle Earth script that you saw, although I understand why, because J.R.R. Tolkien, the author of the Lord of the Rings trilogy, drew a lot of things from Nordic mythology. Instead, that was a symbol called the Eishjálmur, which is essentially a symbol that was often used as a way of protecting against harm in battle or warding off evil, and those were Old Norse Viking runes around it. I don't know why I'm so interested in Norse mythology. If you're really interested in that, you can actually read a very nice book by Neil Gaiman, a great British author who has adapted some of the Old Norse myths into modern language and did a very good job. For some reason, I've really become attracted to that. Also want to visit Iceland someday. Now, today I want to talk about what's going on in the markets. The big thing that we're looking at is sector rotation. Here's a couple of charts that I want to show you, just to show you what that rotation looks like in practical terms. This is a 3-month chart of the S&P 500. It shows we've had about a 4% gain over that period. We've been higher than that. We have pulled back since then. So on the right-hand side, you can see those sliders. And at the top, what we see is that the biggest gains have come in things like materials, financial, energies, industrials, and so on. Now, those are all things that are fundamentally about economic recovery in the real economy. Down at the bottom, what we're seeing is the bottom is led by information technology, which is just a proxy for all that technology stuff that we've been talking about over the last year, all the fancy tech companies, including a lot of SPACs and so on, which I'll talk about in a moment. Following behind that is consumer discretionary. That would be things like appliances, automobiles, etc. There's been a big pullback in spending on that after the big burst we saw last year. Both of those are in negative territory on a 3-month basis, and communication services also, which includes a lot of internet and things like that, also still up, but have pulled back considerably from their highs earlier in the 3 months range. Now, here's the same chart on a 1-month basis, and you can see, wow, we're down big time on the S&P 500. We're down 2% over the last 4 weeks. That reflects a lot of the volatility that we've seen. But once again, the big leaders are all in the real economy. They're all recovery plays: energy, materials, financials, consumer staples, a little bit. Down at the bottom, the big losers are information technology, consumer discretionary, oddly enough, utilities, communication services again. Now, what this tells us is that there is a big rotation away from those stocks that did so well last year into real world, what we call cyclical stocks that are really based on the growth of the economy. If you think the economy is going to be growing, and companies like, in the energy sector or the material sector are going to be generating higher earnings, then you buy them now in anticipation. Here's another way of looking at that. This is XLE, which is one of the energy ETFs divided by the ARKK, the big innovation ETF. Going into the beginning of this year, XLE was really quite low. In other words, energy stocks were going nowhere relative to this fantastic innovative stuff. Now look what's happened. It's just taken off. It's almost heading towards doubling, in value relative to the technology stocks. So what this all means for us fundamentally, we've been talking about this for a couple of months now. There's a big unwind happening. It's an unwind of the speculative stuff that people were chasing last year when they were all locked down and using stimmy, using money that the Fed was pumping out, using money as I said, stimmy, federal money pumping out to buy stocks and so on. That's unwinding now, and that's putting a lot of pressure down right across the board in markets. There are other things going on like inflation, uncertainty around the infrastructure bill, and I think that's a bigger issue than a lot of people think because it is way up in the air whether we actually will see such a bill before the Republicans probably regain the House in 2022. Anyway, all that's weighing on Wall Street, but it's led by this rotation away from the stocks that did so well last year. Here's the hidden bit of it. Well, it's not hidden if you're paying attention, but I'm going to bring it to your attention. And that is the unwinding of margin debt and what that can do to cross-asset valuations. Now, when I say cross-asset valuations, what I mean is that, when you hold an asset, let's say like a cryptocurrency like Bitcoin, you may have borrowed money and bought Bitcoin with that. Well, if Bitcoin turns against you, if the price goes down, the person that lent you the money to buy the Bitcoin might call in that margin debt and say, hey, I want you to pay that money back to me, or else I'm going to force you to sell your holdings in order to recover that money. So what a lot of people do is, when they get hit with a margin call on something like a cryptocurrency or something else, then basically they'll sell another category of assets in order to generate the cash to pay back the margin call. So let's look at margin debt just in general. This is a chart that shows the year-on-year change in margin debt from 12 months previous. We're in uncharted territory here, pardon the pun. That red boost over there is the growth in margin debt at the beginning of 2021. It's way, way, way above anything that we've seen before, and it is growing. It started to pull back very slightly. If you can see, it's maybe hard to see, but at the top right-hand corner, it's pulled back a little bit, but it's still in, it's astronomical at this point. Now, why is that important for all kinds of investors? Well, even if you're not in margin, you're not using margin, the stocks that you hold, if people have taken on a lot of margin debt to buy those stocks and they're forced to liquidate them to pay back their margin debt, then your value of your holdings of those stocks are going to go down along with them. Everybody goes down when margin debt is liquidated. But here's an interesting phenomenon, and Clint Lee and I have been speculating about this. We've been trying to figure out whether this is a reality, but I think there probably are a lot of mechanisms, particularly now that some big hedge funds are involved in cryptocurrencies. Here's a chart that shows the performance of Bitcoin. That big black downward line, that's today on Wednesday. I mean, that is just dramatic. In fact, that represents almost a $1 trillion diminishment of the total market capitalization of all cryptocurrencies just on this day alone. This was on Wednesday when I'm recording this. Down at the bottom, you can see, well, in the middle, you can see the big negative volume spike. This is the last 5 trading sessions, last 6 actually, have all been negative for cryptos, or for Bitcoin in particular. We see the relative strength index for Bitcoin falling below the 30 line, which is normally a sign of bearishness. We see something similar with the stochastic indicator there in the middle, also dipping below the trend line, which is something, again, that indicates extreme bearishness. And then finally, the stochastic, the MACD, also at the lowest level we have seen in the last 9 months. So the speculation that I'm engaging in, I'm using that term in another sense, is that perhaps what we're seeing is some kind of unwinding of positions in the cryptocurrency market that have led people to start liquidating some kinds of stock holdings in order to generate some cash. It's entirely possible. These kinds of cross-asset effects do happen. We see people having to sell things to pay off debts in other parts of their portfolios quite often. Now, if that is happening, it's a reversal of what we saw earlier, which was people selling stocks at the beginning of the year to generate money to get into cryptocurrencies, which is, again, a pretty fascinating, cross-asset type development. The key question is, will crypto slide continue? Now, just as an aside, a lot of people, are pro-crypto. I'm kind of agnostic about crypto's long-term prospects. I want to see a real use case, value case. But of course, when it comes to any currency, the critical thing is whether it's a good store of value. And what we've seen, and I said this on Twitter the other day and got a lot of responses, is that the worst single thing for Bitcoin as a store of value is Elon Musk, because a lot of what we're seeing in the crypto space right now is a reaction to just this one man's tweets and his behavior and his mutterings. That tells you that this is a highly speculative asset and not a proper currency at all. So just be warned, folks. If you want long-term crypto value, you have to find something that's not going to respond to a guy like Elon and his tweets. If it does that, it's not really anything other than a purely speculative asset. Now, let's go back to the question of speculation. Are we at the end of it? Here's a chart that shows short-dated single stock options volumes. And short-dated options are usually the most dangerous because you're betting on a price rise that'll happen in a fairly short period of time. They are therefore highly speculative. And as you can see from the chart on the right-hand side, that option trading really spiked enormously during 2020 and again this year. Interestingly enough, though, it was on the way up starting in 2018, and it actually peaked just before the COVID crisis. We see the dip of the COVID crisis there. And that goes back to something I've been thinking about a lot lately, which is that the animal spirits that have been mobilizing this speculative frenzy that we've seen recently, I think has a lot to do with trends that predate COVID. It's not just about the recent Fed pumping of money into the market. I think there are pressures and sentiment that have been building up before COVID that got a big shot in the arm from the Fed and also from from federal stimulus payments, and that is reflected in these options trading. Now, here's something that I think is really important to understand about speculative investments. So let's turn away from options and start looking at another area, which is SPACs. One of the critical things about speculation is that it has a supply side as well as a demand side. The demand side in speculation is people who want to buy an asset like cryptocurrencies or SPACs or tech stocks in order to speculate on their share price. But the supply side is the people who issue the stocks, who issue the equities that those speculators want to buy. Now, what tends to happen in speculative bubbles is that the amount of new issuance of shares increases as a response to the demand in the market. I mean, that's how supply and demand works. If you see a lot of people wanting to buy highly speculative EV SPACs or any other kind of techno SPAC SPACs, then of course that gives an incentive for people to launch more SPACs. So here is a chart that shows the level of U.S. equity issuance, which is issuing of new shares onto the stock market as a percent of U.S. GDP. The first part of the chart on the left to look at is the internet bubble, the so-called .com bubble, and now we have the COVID bubble. So what we're seeing now is an enormous issuance of new shares into the market coming from people who are basically forming companies, not so much IPOs, largely the SPAC phenomenon. And as a reminder, SPACs are an alternative way to take a company public by reverse merger. Now, here is a chart that shows the rolling 12-month average of SPAC issuance going back to 1995. A little bit of a bump in 2007, just before the great financial crisis. Started to pick up a little bit after 2015, but look at, oh my gosh, 2019, 20, and 21. Again, this is totally uncharted territory. SPACs are out there. Now, why should you care? Well, fundamentally, as I said, there is a supply side to speculation as well. If people express a lot of interest in speculative assets by buying them, like cryptocurrencies, then somebody will produce more of those things. We saw that with the initial coin offerings back a couple of years ago, when people tried to basically bilk people out of money by issuing new cryptocurrencies all the time. With Bitcoin, obviously, it's different because it has a capped supply, but fundamentally, what we've seen in cryptos is that people have been putting new crypto products out into the market in response to interest in them. Most of those things will have no value and will fade away and disappear in short order. The same thing goes with the SPAC phenomenon. I mean, somebody talked the other day about, I read an article about the LiDAR sector. We hold LiDAR stocks in the Bauman Letter. Now, LiDAR is a form of basically radar ranging or light-based ranging that allows you to get 3D pictures of various surfaces. Now, it's great for aerial photography, it's great for aerial mapping, but it's also increasingly being used in autonomous vehicles because it allows those vehicles to see in real time and then react based on what it's seeing. Anyway, 5 different LiDAR companies have gone public in the last year or so, including the one that we hold in the Bauman Letter. Now, what's happened is that you now have 5 competitors in a market that is just starting to develop and picking up steam. There's no way all of those companies are going to do well. And yet people have bid up their prices dramatically over the last while. Eventually, what's going to happen is that some of those companies will fail. Some of them will merge or be bought out with by others. And in the end of the day, you're going to end up with maybe 2, maybe 3 big players, or that the technology will become generic and will be adopted by a variety of different producers as a commodity play rather than as a specialized technology play. Now, what that means is that all the money that people have put into those companies now is going to experience a long-term rate of return on capital that is going to be far lower than the speculative gains that people made last year. But that's what always happens. Whenever people start issuing more assets to feed the speculative demand for those assets, it means that eventually all the money that those people spend on those things is going to get sucked down into a long-term rate of return that is comparable to all other industries. You just do not see permanent rates of return for any asset class that continue to exceed the long-term rate of risk-adjusted return for other asset classes. Things even out. Otherwise, you arbitrage the difference. So what I'm saying here is that I think what we're starting to see is the beginning of the unwind of this process. We've seen issuance of new SPACs decline this year. We have seen a lot of change in just the whole attitude of the market towards the technology and speculation. Now, what comes next? That's the big question. And my proposition is that we're going to see something that happened the same way after the dot-com bust. Now, here's a chart that shows an index which essentially has value on the top and growth stocks on the bottom. It's a ratio, which is a great way to show the relative performance of 2 different asset classes. The lighter green line shows the performance of value stocks leading up to the dot-com bust and then afterwards. And what the chart says is that after bottoming in February 20, value went on to beat growth by 14.3% on average annually for the next 7 years. Now, the darker blue line is what's happening right now. So we've also seen a big slide in the value of growth stocks relative to value, or rather value relative to growth. But what we're seeing now is a turnaround. If you look at that little sort of brownish uptick down there at the bottom of that dip, that is what's happening right now. That's what's happening in 2021. And if we see the same pattern that we saw in the aftermath of the dot-com bust, that's what we're going to see. We're going to see value stocks do better than growth stocks. And that's going to be reinforced by a growing economy if we end up with a growing economy, of course. And it's essentially a strong bet that that's what we're going to see. Now, obviously, there are a lot of differences between now and 1999. Interest rates are at much different levels. Today's technology companies are much asset light, which means that you can have higher valuations, all that sort of stuff. But the reality is that growth stocks have not achieved earnings growth that justify their even their valuations now. What's happened over the last couple of years has been price appreciation based on multiple expansion. In other words, people being willing to pay more for every dollar of earnings either now or in the future, and that eventually becomes unsustainable. And when you hear people starting to say things, oh, well, it's different this time, this is sustainable, that's when you know you're in trouble. And of course, we did hear a lot of that. We still do hear quite a bit of that, particularly in the crypto space. But what happened after the dot-com bust was that fundamentals started mattering again. People started saying, I am going to buy companies that have strong earnings growth, and I'm going to ride those companies up on the basis of that earnings growth, not on the basis of multiple expansion. And as I've said a couple of times, that's slower, but it's more stable. And it's, basically, if you want to beat the market in that kind of environment, you go looking for companies that outperform its peers. You look for companies that pay dividends, and you compound those dividends. Dividend payers have a history of beating the overall stock market by a long shot over time. And growth companies rise, then they fall. Dividend payers, if they're good, they just keep rising forever. Anyway, long story short here, folks, is that we are in a situation where we're going to be looking at a big rotation, I think, into value stocks, which means companies that are cheap relative to their earnings potential. So instead of looking for hype, you look for earnings growth, you look for revenue growth, you look for increasing market share, and so on. And in that space, I think we're starting to see that even in the renewable space, which a lot of people are seeing as a speculative play right now, they are starting to become value plays because they're cheap and they are going to grow. There's no question. Of all the technology sectors today, 5G, Internet of Things, you name it, self-driving cars, flying taxis, the only one that is guaranteed to do well, I think, over the next 5 to 10 years, regardless of anything else, is the renewable energy sector. Not just because of public policy, but because this is what the market demands. They want renewable energy. They want to move away from fossil fuels. And as a result, my recommendation is play value, but also look for the companies that are earning money in the renewable sector already, that are growing actual revenue and paying profits and starting to pay dividends. I've got a couple in the Bauman Letter, and some of them have pulled back pretty strongly along with the rest of the renewable sector, but that's because they tend to be lumped together in ETFs with other companies, and those ETFs sell them when the ETFs go down. That makes them a bargain right now. So that's my recommendation. I think we're at the end of the speculative bubble. You're going to see the supply of speculative assets dry up. Get out of them while you can. Get into value, particularly in the renewable sector. This is Ted Bauman signing off. I'll see you next week.